Charlene Ramdani, Senior Manager, Strategic Communications and International Relations here at Central Bank. And I'm also an incoming member of the bank's Monetary Policy Committee. So a little bit as to why you're here this afternoon for this monetary policy press conference. As we've said before in the past, as you're probably familiar by now with hearing us say this, for us here at Central Bank, we are basically keeping up with the latest trends in central banking. And that is the fact that communications is now seen as the newest monetary policy tool. So we at Central Bank fully believe in that ethos and look at basically the value of communications with our stakeholders. And with that said, for us, it's important that our stakeholders can understand the reasons and the rationale behind our monetary policy decisions. So that's why we have been more proactive in our monetary policy communications. And you may recall that started back in 2013 when we went to Debe for our first monetary policy forum. And that continued into 2014 with the monetary policy forum that we had in Tobago and the last one we did in Chaguanas. What we have also done, you would have seen last year, we turned the what you all became accustomed to as the repo rate announcement, we turned that into the monetary policy announcement, where we sought to give a little more explanation behind why the rate stayed or why it moved up. So this is just a continuation of that and an expansion of that approach to communications as a monetary policy tool for the sake of being more effective as a central bank. So as we said, we would usually and traditionally communicate the changes in the repo rate or any movement in the repo rate through a press release. And what we have done now, as of 2015, that will now be done in the form of the Monetary Policy Press Conference, which is why you're here today. So basically, how we've been doing it, every 2 months we would issue the monetary policy announcement. So basically, you can look forward to coming into the central bank for, another 5 press conferences for the rest of the year. So you'll be seeing us a little bit more. You'll be coming into central bank a little bit more. So what I do right now is I'd like to introduce the central bankers on the head table sitting here with me. To my extreme right at the end, we have Ms. Sandra Racha. She's a career central banker. She's been at the bank for over 12 years. She's the head of the research department as well as chair of the Monetary Policy Secretariat. And it may interest you to know, as I said to some of you earlier, she's an energy economist. So you can understand her importance to the bank these days. And of course, to my immediate right, we have Governor Jawala Rambrand, who is, I'm told, a career central banker just as well. You may know him. He's quite a popular guy these days. He is the chairman of the Monetary Policy Committee. So with that said, with those brief introductions, I will now hand you over to Governor Rambrand as he will make the January 2015 monetary policy announcement. Governor.
Thank you very much, Charlene. And good afternoon to everyone, and again, welcome to our first monetary policy press conference for 2015. At its January 2015 meeting, Central Bank's Monetary Policy Committee agreed to a third consecutive increase in the repo rate by 25 basis points to 3.5%. The Monetary Policy Committee based its decision on 3 factors. The first and most influential factor was recent interest rate guidance from the U.S. Federal Reserve about the future path of its monetary policy. The second factor related to signs the Trinidad and Tobago economy seems to be approaching full capacity. And finally, the Monetary Policy Committee considered the still positive growth outlook for the non-energy sector in the context of the steep decline in oil prices. Following its December 2014 meeting, the U.S. Fed's guidance on its medium-term course of monetary policy signaled the Fed funds policy interest rate would likely increase to around 1% by the end of this year. As a result, global financial markets are now expecting the first increase in the Fed funds rate in 8 years to take place around the second half of 2015. This anticipated increase in U.S. interest rates is expected to make U.S. dollar assets even more attractive to investors relative to TT dollar assets and could prompt additional portfolio capital flows out of Trinidad and Tobago in search of high yields. Although the interest rate differential between TT and US dollar assets has widened somewhat over the recent month, domestic interest rates must move from historic lows to maintain a comfortable enough position relative to US interest rates. By January 20th, 2015, the TT-US interest rate differential on benchmark 10-year US Treasuries compared to our TT rate stood at 53 basis points relative to an 87 basis points that was there prior. There are signs the Trinidad and Tobago economy seems to be approaching full capacity. This is reflected in the movement of a number of economic indicators. Headline inflation is creeping up, reaching 8.5% in December 2014 from 5.5% at the start of the year. The pickup in headline inflation is mainly due to food price inflation, which remained in double-digit territory, almost 17% for the sixth consecutive month in December 2014. The acceleration in food prices largely reflects rise in prices for locally produced vegetables and fruits. Unemployment is now at an exceptional low at a little over 3% of the labor force, with the business community reporting shortages of skilled workers, which could push up wages in the private sector. Consumer credit continues to expand at a very strong pace, helping to finance substantial imports of consumer durables and contributing towards significant excess demand pressures in the foreign exchange market. In face of declining oil prices, the government has substantially revised downwards its energy price assumptions for the 2014-2015 budget, but it intends to return to the original fiscal deficit target of roughly 2.5% of GDP. This suggests the government is likely to maintain its expansionary fiscal stance that would further add to elevated liquidity levels that are currently around $6 billion and could push up core inflation. The positive momentum in the non-energy sector has delivered fairly respectable growth for 15 consecutive quarters to December 2014. And the near-term outlook is for continued steady performance in the non-energy sector. Boosted in part by strengthened growth in the United States and softer oil prices, the tourism-based economies of CARICOM should see some uptick in activity in 2015, and this would provide further support to Trinidad and Tobago's non-energy exports. Finally, Central Bank has put in place a program of intensified open market operations to aggressively remove excess liquidity from the banking system in coming months in order to support our repo rate adjustments. Larger and more frequent foreign exchange interventions aimed at preventing systemic foreign exchange shortfalls will indirectly contribute to removing some of the excess liquidity. And Central Bank is prepared to further position its monetary policy stance to address any challenges that may arise from unanticipated changes in global energy markets. And just so that you know, our next monetary policy announcement is scheduled for March 27th of this year. Thank you very much. And I'll now invite questions.
Governor Rambaran, the central bank injected US $400 million into the banking system this month. It seemed as if this lot, and you said it was the biggest injection by the central bank so far, it seemed as if this amount was done because of an intervention by the Prime Minister, who called on 3 government ministers to meet with you. Is it because of that? And if so, if you had your own way, would you have pumped this much money, this much foreign exchange in within 1 month?
Let's make it clear. There's no political pressure when it comes to the central bank conducting its operations in the foreign exchange market. We have actually done our medium-term forecast of the country's balance of payments, and that forecast suggests that we are likely to see a continued buildup of international reserves over the next 3 years. The forecast also assumes very conservative prices for energy commodities. We've actually used the very same prices that the government has repegged its budget to for 2015, but we have also taken into account that energy prices are likely to remain low over the medium term. So we're treating it as a cyclical phenomenon. And therefore it means at some point the central bank has to respond to what it is treating as an external shock, that is the fall in energy prices. Second, to bear in mind, having done our balance of payments forecast, it gave us a window to indicate what would be the level of intervention that we could undertake in the marketplace. And that was also based on the fact that when we looked at what was happening in the fourth quarter of 2014, we saw demand averaging about $600 million for that quarter. But in January of this year, demand has jumped to almost $650 million. At the same time, supply averaged about 430 million in the last quarter of 2014. And into this month, supply has dropped by almost half to 265. If you actually work out the maths, you would see that the excess demand amounts to somewhere around $385 million, and we have put 400 million in, which makes it very consistent with our policy that we've had in place for more than 2 decades. That is, the central bank will meet the systemic shortfall in the system. And that is what we've continued to do. So, Judy, to answer your question, there has been no political pressure to undertake these interventions in the foreign exchange market. This remains the work of the central bank, and it's based on the exercises that we've done with respect to the medium-term balance of payments and the developments in the foreign exchange market. As you would have seen in our media release that went out 2 days ago, we did indicate that given that we're treating energy prices as a cyclical phenomena, that means it's likely to be lower over the course of the next 3 years, we are then prudently reacting to that particular phenomena by using a little more of the reserves to clear the unsatisfied demand that has come forward into 2015, and to also help clear some of the demand that has been brought forward, given the general uncertainty that has been prevailing in the domestic economy since the start of the year over falling crude oil prices.
The U.S. is one of our biggest trading partners. It's reporting that its economy is growing. What does this mean? What does that dynamic mean for Trinidad? And then the Euro regions are saying they're going into a situation of deflation. So what does that mean for our economy? Is it going to have any measure of impact?
As indicated, Natalie, the U.S. is actually one of our strongest trading partners, but now really on the non-energy side, not for energy exports. With a strengthening U.S. economy, then you're likely to see the positive spillovers that could take place in the Caribbean, as we've mentioned in our monetary policy announcement. Once the U.S. economy continues to strengthen, it provides a boost to our markets in CARICOM, and therefore it means that our manufacturing sector can now export more to the region. So it's a benefit for us. And we've actually, when we look at our balance of payments over the next 3 years, we are actually seeing a pickup in non-energy exports, primarily due to the strengthening U.S. economy. There's also a boon there in that the U.S. is no longer our largest market for LNG exports. 10 years ago, almost 90% of our LNG exports went to the United States. In 2014, just around 5% went to the United States. And that means we now have a well-diversified LNG export portfolio, which would help cushion shocks around the world, both in relation to the growth differences you see in Europe and Asia, and in relation to prices.
You met with the business community, I think about last week. One of the things coming out of that is that you're going to have monthly meetings with them. How does meeting with the business community help the central banks work?
Actually, that is not new. Over the last year and a half, as part of our communication strategy, we've been meeting regularly with the business community. What we've done this year is to actually put in place a more structured program in terms of quarterly meetings with various business groups around the country. Those meetings are always candid, free, and frank, and it gives us the opportunity to hear firsthand what are the views of the business leaders, and those views are obviously then taken into account when we undertake our monetary policy decisions.
Headline inflation, you put it, I think, at 8.5, is it?
8.5%.
Yes. Is that a worrying figure? And then just talk a little bit about the core inflation as well. You just pointed to it, but can you give us a little more details?
Yeah. As we indicated, headline inflation has been creeping up over the last year. Would we say it is worrying? I would say it is of concern to the central bank because it is one of the signs that suggests that the economy could be reaching close to full capacity, along with all the other indicators that we've mentioned. Core inflation, on the other hand, has remained relatively stable. Over the last year, it's ranging anywhere between 1.5% to 3%. So that is pretty manageable.
Governor, just to pick up on my colleague's question, when you talk about the economy being almost close to full capacity, does that mean it's in danger of almost reaching overheating period? That's my first question.
Yes, in the sense that what you're seeing in some markets are that resources seem to be almost fully employed. And if we look, as we said, at the labor market in particular, with this exceptionally low unemployment rate, it basically means anyone who wants a job has a job. Even with the high level of public sector programs, and we understand that with the business community, there are discussions on the way to make some transitions there. But what that would simply mean is a reallocation from the public sector to the private sector. At the same time, as we've indicated, you do have the business community saying that there are shortages of labor. And we've seen that also reflected in the level of inward migration that's been taking place over the last few years. I mean, with Trinidad and Tobago still remaining a pretty strong and resilient economy, you've seen persons coming not only from the Caribbean, but outside of the Caribbean to also work in Trinidad and Tobago as they look for better opportunities.
Indeed. Governor, my second question is based loosely around something that happened last week at AmCham, where a number of senior level business people and also senior bankers met with AmCham, and there was an open public meeting in which there were calls and complaints that the central bank was not helping the local businesses with US dollars. Now, of course, you did say you put $400 million into it. Now, based on that fact, and in fact, I spent 3 days at the energy conference in the Hyatt this week. I sat in many roundtable discussions, and one of the key points coming out of it from some of the local businessmen trying to do or attempting to do business with energy partners abroad was the fact that they were a little unconfident in terms of like being able to go forward, whether they can sign a deal and whether they would be able to honor their future contracts with those people. Is that something that you could address for the community?
You speaking in respect of the
the
energy
availability
contracts?
No, I'm speaking in terms of the availability of US dollars going forward, more to give more confidence to the business community who want to do future business with our future partners.
Well, as we've indicated, the central bank can give the assurance to the business community that we are indeed making larger and more frequent interventions we've said we plan to basically clear the unsatisfied demand and clear some of the precautionary demand that has been brought forward. And therefore, you could look forward to further easing over the coming months. Based on the data that we've seen coming in over the last month, substantial businesses have been receiving foreign exchange. You may not have received all that you've wanted, but the process has started. And I think the tensions are beginning to ease.
Governor Rambra, just to follow up on the question that my colleague asked, at the same AmCham function, businessmen were saying that the central bank, their banks are telling them that the central bank is dictating which businesses can get foreign exchange. The trade minister was there at the function, and he said that is not the practice of the central bank to get involved. So the businessmen were saying that's not what they've been told by their bank.
All right, let's make something absolutely clear. The central bank's policy, as I've said for more than 20 years, is to meet the shortfall in the system. And that is a practice that we've continued by meeting whatever is that shortfall between demand and supply. So we come in at the system level. The relationship that exists between a commercial bank and its client, the central bank does not get involved in that. It is up to the bank, to the commercial bank, to decide how much, when, and why it will provide foreign exchange to its clients. That is not the business of the central bank. We remain at the system level in terms of our operations.
For those people who are not as in depth with the economy, when you say the economy is reaching full capacity, does that mean you're not expecting much growth and stagnation in terms of that sort of thing and business activity? Exactly what do you mean in simple terms for the average person on the street?
That's a very good question. Full capacity is a term that economists use to basically indicate that much of the resources are being used up and that it will eventually spill over into rising prices, basically, whether in terms of wage rates, whether in terms of higher salaries, whether you pay more for construction items, cement, steel, whether you eventually end up paying more even for locally produced vegetables. It generally means there is so much demand in the system, we do not have enough supply to meet that demand. And therefore, the only way you could get an adjustment is through higher prices. And that is why you've seen that since September, we've been in the process of consistently raising our repo rate as in an attempt, one, to preempt the inflationary pressures that are likely to arise from such a situation, but also to help insulate the economy from the external shocks that are taking place. And that monetary policy stance is being supported by our foreign exchange management program.
Governor, I have three questions. On December 1st, you gave 0.5% as the GDP for GDP growth for 2014. That was on December 1st. Do you want to revise that now? And second, what's your projection for 2015?
All right. We have not revised that growth number. Even though new data has come in, it seems that we're likely to maybe hit somewhere around there in 2014. So that number remains unchanged at the moment. If there's anything, it may go up maybe a few percentage points. In terms of our estimate for 2015, surprisingly, despite all the negative sentiment around falling energy prices, when we look at what's happening in the energy sector in terms of production, and so this is outside of the price effect, so we start to talk about real economic growth, and that means we're looking at actual productive activity. We are seeing some increases in across a number of the sub-energy sectors, especially LNG production and natural gas production. You would recall that the Starfish well came on stream in late December last year. That well is expected to be fully operational by March. When we factor in the numbers related to starfish, and we assume that the supply disruptions that we saw last year, which was actually one of the worst years on record, that those supply disruptions could actually continue into this year, we still get a very positive number for energy sector production, because natural gas production would go up, and that means LNG production is likely to go up, and that would have a spillover throughout most of the energy sector, particularly in relation to natural gas liquids and some of the petrochemicals. So we are actually looking at, surprisingly, a turnaround in energy sector production and growth for 2015. And this is outside of the price effect. We are talking here now, as I've emphasized, the volumes and the actual levels of production, which are not going to be, which are independent in a sense when we measure economic growth.
So you see further growth, not a contraction.
Not a contraction.
Okay. You want to put a number on?
Not yet. I will actually give you that number, the national community, that number next week, Wednesday, when I present the economic outlook at the Chamber of Commerce.
All right. The other thing, falling oil prices, what impact is that having on the current account balance?
Right. As we've indicated, our exercise on the balance of payments over the next 3 years suggests that there's likely to be a buildup of reserves. When we look at energy exports over the next 3 years, from 2014 to about 2017, given the movement in both prices and production, what we see is a drop of about US 1.7 billion over the 3-year period, which is really not that substantial a hit as one would expect, because you have these mitigating effects that are taking place. You have higher output for LNG, ammonia, urea, and methanol. You have lower output for crude oil and some of the natural gas liquids. And while you still have some higher output for iron and steel products. So what you have is compensating movements that are taking place across the various energy commodities, and given the assumptions we've made on the prices, and bear in mind, I have said we are using very conservative price estimates. So we've actually taken almost what you could consider a worst case basis for 2014 in terms of energy prices. And we've modeled that through our balance of payments.
Just curious, what is the biggest challenge which the central bank has to face when it comes to all these changing scenarios happening all at once? What is the challenge when you look at it and in balancing yourself? What is the picture you face?
Well, as a central bank, we've been very much accustomed to dealing with these challenges for the last 50 years. Right? We've come through various ups and downs across the economic cycle. So what I would say is that, in a sense, it is not new for the institution as a central bank. We're very much prepared in terms of the people with the experience behind managing across various business cycles and economic cycles. And it is one that we, as we've said, we are here to ensure economic stability. And that is what we'll continue to do through our various policy instruments.